So trading methodology. Well, there's quite a few various ways that we can look at the markets, and the trading methodology is kind of a vague term. It's kind of a well, it's not a vague term, but it produces some vague ideas of what trading is. Um, because methodologies is really just mean your approach to the market or the way that you trade the market. Now, yours truly, I am a Ganalist. I'm a Gann trader. I love to use market geometry in my trading, and that is the fundamentals of how I trade. I also use day counts, and I use financial astrology. So that is the way that I trade. But that's not the only way to trade. It is certainly not um, a common way to trade. A very common, really probably a common way to trade method. Well, I'm going to stop babbling and just say that one of the really popular ways to trade that got very popular probably ever since 2008 to now is something called swing trading. I'm sure you're all familiar with swing trading, but swing trading is probably one of the most well-known methods of trading, but it's also one of the most subjective as far as um, how you what is considered a length of time to swing trade. Certainly, for some people, when you're discussing swing trades, back in the day, that was for stocks, and you would hold stocks for a swing trade for a period of months. And then over time, that just kind of got reduced down to weeks and even to days. And and then position trading is that plays over years. But as far as for forex, we can pretty much say for forex that swing trading is holding anything for a period of days or a period of weeks, and then a position trade is probably more like a carry trade where you are holding on to the trade to generate the interest on it. Um, for instance, the pound dollar. I've been short the pound dollar for about 2 weeks, and yeah, about 2 weeks. And I've been adding on the rise up because I was forecasting a turn in the market around this time, anyways. But the move down or the move up didn't bother me because a lot of these, I know we were at these market highs in the pound dollar, and we're going to have a pretty strong decline down. But the positions that I entered into here, while they are in the red, they're going to return to positive value. But I plan on holding on to them for a long time because I make money every day on holding it. I get paid interest. For instance, I've got one lot open at 141.27, and I've had that open since the 6th, and I've made $42.25 on that swap. But I've got 5 lots open at 142.17, and I've generated $83.75 on that one, and I've had that open since um, the 12th, as I was looking at it on my screen. So I have a lot of shorts open in the pound dollar that I'm very comfortable holding on to for a while, and not in the short term. I'm not worried about the drawdown because I'm generating interest. It's a carry trade for me. I'll be hanging on to it for a while, um, and so that's a strategy that some people employ. But I'm really more of a I'm really more of a swing trader. I like to find positions that I can hold over a few days or a week or so. So swing trading is really just identifying some type of low and then some type of high and trading between those. So if I'm looking at the daily chart, and if I know that there's this pretty consistent rising trend line here, then I know that there's also another trend line. So we basically essentially have a channel. So I know I've got this channel, and after a couple times I can probably assume that this will hold structure. And so if I'm swing trading, I can really easily identify where I'm going to enter and where I'm going to exit or reverse position. So, if I had noticed this happening, if I noticed that there was a swing low here and then a swing low high that formed a second high, and then there was another swing here. If I've got at least two of those, that's enough to form a channel and then trade off of it. So it could have made an entry here, and then you exit when this price approaches this channel. Maybe you want to exit a little bit before, and then you would close your long and probably maybe enter a short. And if you still were trading off that channel, you would do the same thing down here. All right, so that's an example of swing trading. And you would hold these. Let's say you entered a long here, and it's the 12th, and now we're going all the way up to the 24th of January. So you would have held it for a couple weeks, a few weeks, and that's swing trading. I think swing trading is a lot less stressful and a lot less of a headache. And you don't have to babysit your positions as much. You don't have to, freak out about what is going on with your positions or worry a lot. You just you have a pretty solid entry based on a trend, and you limit your risk based on your entries, and you just and then you put various profit targets if you want to, and just kind of ride it up. It's pretty simple process to do. It can make it a little easier if you can go a little bit more advanced and utilize Elliott waves to identify, where these legs may happen, where they may form. So, if something like this is not a complete wave, but you know what I mean. If you can implement a lot of other forms of analysis to enhance the profitability of your swing trades. Now, another form of or method of trading, and I think what I'm going to end up doing is I'll probably end up going over various styles of trades, and then types of trading styles and methods, and then do that for like a whole week or a period of weeks. Kind of go over different ways to do it. So you could do swing trading, and then reversal trading, position trading. Breakout trading is, a lot of people like to breakout trade. I'm not very good at it. That is just a style of trading that I have always struggled with. I don't like to trade breakouts very much. Well, I do, but I guess not in the traditional sense. Let's see. Let's use the dollar yen. We were looking at this yesterday or this morning. So the dollar yen, if we are talking about breakout trading, there's probably, when people think about trading breakouts, they're thinking of Darvas boxes, or they're thinking of Bollinger Bands. I think Bollinger Bands are probably one of the most popular ways to trade breakouts after a squeeze. In Forex, if you're trading breakout trades utilizing Bollinger Bands, you can really have a good time with this, because the time periods of trades, you got the London Open, you've got the Tokyo, and then the New York sessions. And as these sessions close and open up, there's periods of time where the choppiness or the volatility of the market kind of condenses, and then you enter these squeeze zones. So right here, this is pretty normal to have happen, where you have this is at the end of the U.S. session. This is 2 p.m. Central Time, and we just kind of have some flat trading here, and the Bollinger Bands reflect that flatness because they're not the outside of the extremities of the Bollingers, the upper and the lower band are not expanding anymore. They contract, and when Bollinger Bands contract, that means that the volatility is decreasing, and Bollinger Bands are probably one of the most popular volatility indicators. John Bollinger is the man who invented these, and trading Bollinger Band breakouts. So they call this a squeeze or Bollinger squeeze, and then this is the breakout that happens. Now, oftentimes with Bollinger Band breakouts, when things break out of a squeeze, there are a lot of head fakes, because after a squeeze, you see price drive up really high, and you think, oh, cool, okay, so that's the direction the market is going, but then it fell down. Okay, well, why did it fall down? Why did it bust up here and break above the Bollinger Bands, and then why did it sell off? Well, we have to use another type of indicator to look at that. So we can use the composite index, which is my favorite. And one of the sure signs that something is going to reverse off of a Bollinger breakout is where is your oh, what in the world? Because I already had those on there. Is when you're in a squeeze and then you start to test the upper or the lower end, look at your oscillator. All right. If I'm not even close really to overbought here, but in the composite index, it's telling me that I'm really not in a buying condition. I'm in more of a selling condition. And so certainly probably at the close of this candlestick, you would definitely go short, and then you fall through. Okay. And then but prices can ride a Bollinger Band for a while. But one of the most effective ways to trade breakouts is utilizing Bollinger Bands and your oscillator. So if prices are, let's work another example. Okay, here we go. So we've got prices trading, and notice how the bands come in. They're entering a squeeze, and then price starts to trade lower, and it starts to test the lower band. But while that's happening, look at what is happening with the oscillators. When the composite index, this is the red band, is well below the green and the yellow, we have a good condition for buying. We don't have a very good condition for selling. So when I know that we've broken below the lower band when we've just started a squeeze, and then we have a green close, a bullish close on the next candlestick, you are in a very safe position to go long and trade up. Okay, I know people who trade breakouts, like breakouts in the Ichimoku system. There's a high probability of getting faked out of those. So breakouts, I like to see confirmation with the close of another candlestick. Let's see, what else could we use as an example? Breakout trades. We'll come back to breakout trades. Another method that we could go over is pivots. No, we could do trend trading, range trading. Range trading is I bet a lot of people are familiar with trading ranges. The trick with trading ranges is I feel like trading ranges is very subjective because you are kind of putting up some very dynamic entry points. So, well, we could use this past price action as an example. So trading ranges is really just trading between the extreme high and low of a particular price range. And you got to think of ranges not as a static number, but as like an area. So if I want to trade a range, I really don't like to use just a horizontal line like that. I mean, I do now, but when I first started trading, I shouldn't have, because I think this better reflects how to trade a range, because a range is not a static number. It's like an area. Okay. So the high swing part of a range trade is here. And then we would look at, where's the other kind of area that we're looking at in this current trading, we could say is right here. And I'm saying this is trading between these two areas because that's what's been traded the last few days. And so then we go in on the hourly. All right. And then when we're trading a range, we get a pretty good idea of where to enter and exit. This is kind of like swing trade, but we're trading within this tight range. So, the structure seems to hold fairly consistently. And then really this just turns out into a type of breakout trade. So if this is the high zone of our range and this is the low zone of our range, then we would transition into breakout trading if price breaks beyond these areas, because that's probably what happened over here. Okay, is that we had price trading within this range, these upper and lower ranges, and then look what happened. We started to trade higher. Okay, we had a breakout above, and then that breakout zone ended up becoming the new support. So we've all seen this kind of activity before. Some people love to range trade, and some people love to trade in trending markets or are counter trend traders. I'm a huge counter trend trader. I hate ranges. I don't trade ranges very well, but a lot of people love to trade in ranges. I've just never been very good at it. But trading in a trend or being a counter trend trader, looking for that first change or turn in a market, that's how I like to do it. But there's a lot of people who are very comfortable being a range trader. And the best way that you can get better at range trading, or what is the most effective and like probably the easiest, is by using an oscillator like the RSI. We'll get rid of this here. Oscillators are designed for ranging markets. You can use them in a trending market, if you're careful, but oscillators were really designed for a ranging market. And you'll notice that the overbought and oversold default conditions in a range trade really do work very nicely as places to go long or short. Okay, like we can see that repeated here. This level here, we're oversold, and we're right on a swing low area. Prices rise up, and it's kind of trader discretion what they're going to do here. But if your conditions are, you want to wait till it hits this area and you're in a near an extreme level on your RSI or whatever oscillator you're using, then you can trade this. All right. That's one way to do it. And then and that all kind of falls into, people who like to trade pivots. And there are just a ton of various types of pivot points. Now these are TradingView standard pivot points. But there are very, very many varied forms of pivots. So we have Camarilla pivot points. So we can see where the the first, second, and third lines of resistance and support are using this form. Then Tom DeMark, he's his group of indicators, they are used a lot in professional software like Bloomberg. Very, very, I don't think they're worth the money. I think it's funny that people pay for them. I do not think they're very superior. Some of them are just kind of a more shiny version of existing indicators that you have to pay a stupid amount of money for every month. It's silly. I could spend a whole session talking about how scammy those are. Just a minute here. Okay. I think probably my favorites are Woody's pivots. Just responding to this person. So Woody's pivots, they're just tiny different than normal because they give Woody's pivots are more. I think they're just more sensitive and they're more accurate because they give a lot of respect to the previous closing period. And so I think I think people who like to trade pivots or sound like they would like to trade pivots, I think that they would find a lot of use out of using Woody's pivots. And so these are the daily pivots using Woody's pivots. And if we were, sorry, those are the 4 hours. And if we bring it down to the 1 hour, and I think we can even, yeah, so let's say we want them on the daily. So these are the daily pivots. We're looking at an hourly chart. And we can see, how these zones play out. We can even put them to be weekly. And then we can get a good view of how they're working. So, if we're trading pivots and we like to trade breakouts, what are we looking for? Well, if this is the pivot on the weekly using Woody's and we are kind of trading up, near, and against it, we're not in a overbought or oversold condition, then what we're looking for is a nice close above this area. And what we don't like to see, if we're trading near a pivot and we want to go up, we don't want to be in an overbought condition as we get there, okay? Because we are 7 pips away from this pivot. And so we really do not want to trade higher on overbought conditions, which we are not. We're actually in a supportive buy area here on the composite index, and we're neutral in the RSI. So if we were to go long here and price were to trade above the pivot, we could expect that to hold. We could expect that to be considered a good breakout because we did not approach it from overbought conditions. And as a breakout trader, if you're going to trade a breakout above the pivot, you would put a buy entry somewhere above this zone. Or if you are a more conservative trader, you would wait for the breakout to happen and then you'd be trading on a pullback. So pullback trading, you would wait for it to come back and test this area again. So, that's another method is pullback traders. They like to see a move happen first. So if it were to trade above here, price moves up, but then what it does is it comes down to test this line. And then once it tests it and it's confirmed to hold, then the pullback trader is going to enter a trade and then just kind of ride with it for a little while. Okay. Whereas somebody who was aggressive, they would have gotten in, now or earlier, and yeah, it's just it's a very different. There are very many and varied ways to trade markets and how to look at them, and neither is better than the other. Um, but I'll tell you one way that you should not trade, and I will preach this to the heavens. Get these plotted on here. This is not how you should trade off of moving averages. There are so many people that learn about moving average crossover systems when they first start trading that they think that they are good and profitable, and they are not. Moving averages are the definition of a lagging indicator. Fran, um, I believe that's right. I can't remember. Ken Wood. Yep. He has a few indicators like Woody's CCI. Um, 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 yeah, he's got good stuff. But trading off of moving averages is just a recipe for disaster. I mean, it's already telling you what has happened. It's not giving you anything to say what will happen. There's only one moving average that I think is of any salt that I would say sure is maybe the 200-day moving average. But the thing is if you need a moving average to tell you what direction a trend is going, that you just should not be trading. You should be able to look at a chart on a daily or a weekly and be able to tell if a market is trending or if it is in a range. And if it is trending, you should be able to tell which direction it is going. A moving average does not help. For instance, let's say we are, let's say we were saying you buy on a crossover of the a fast moving average. So let's say we're going to take the green moving average, which is the 11 period moving average, crosses above the 21-day moving average. Okay, it's going to paint on this here, and so you go long, and you're not going to get very far. It's just going to keep going. So it is not a very effective form of trading. I think it's dangerous. Moving averages are sold to new traders like it's a holy grail, because people who are new to trading, they find everything confusing. But it's very easy to tell a new trader, well, these are moving averages, and look what happens if you would have gone long here. You would have made 50 pips. That's all you have to do is just trade moving average crossovers. And it doesn't work like that. It really does not work like that. Trading price structure is much more effective, efficient, and safer. And candlesticks themselves may not be for everybody. I mean, if you think about it, I don't know how Japanese candlesticks became the de facto default form of chart analysis, but candlesticks are really confusing for new people. They're really confusing for people who are experienced in the markets because there is a lot of definition and a lot of theory and a lot of explanation and behavior attached to each and every candlestick. What exactly is a doji? Can there be a wick on top of a hammer? Can an inverted hammer have a wick below it? Is it is a gravestone doji? Do you really have to have no difference in the open and close? There's so many rules. It's actually more confusing than determining the appropriate way to apply Elliott waves. There is so much subjectivity involved in it that you just go bonkers. One of the things that I used to do when I was first started trading is besides using the Ichimoku system to get profitable, I used Renko bars and Renko or Renko bricks. Renko is just, I think, for a lot of people, it is a very oops. What am I on the? Oh yeah. You know what? I shouldn't have done it like that. No wonder. And I'll get rid of the pivots. Now Renko, you'll notice it looks a lot different, right? These are just bricks that form. Now Renko filters out the noise. All right, candlesticks are noisy because there's so much stuff that happens. You could be stuck in a 10 pip range for hours. Okay, you could be stuck there for hours. Renko does not involve time. Time is not involved with Renko. It is just price. So each one of the, like right now I have it set to 0.1, so that means each brick hold on one second. Uno momento. Okay. Sorry, I had a phone call. I hate those calls. Okay, so Renko bricks, and normally I don't answer the call. It's just that the same number called me twice, back to back, so that usually means something. And this time it wasn't. Okay, each brick is a determined amount of movement. So right now I have it set to 0.1. So if on yen pairs, that means 10 pips, okay? So I have it set to move 10 pips. So in order for this brick to form, it needs to move 10 pips. So this is at 105.80. Once it goes past 105.90, it forms a green brick. All right, and then you just see how it moves. Now, to form a red brick, you just need 10 pips below. So to form a red brick, you need 10 pips of down movement. Now, the power of using Renko in your as a trading method is that you can see where markets turn very easily. And what makes this extremely powerful is that if you think about it, this has to move a lot. So here's our Renko brick up here, okay? That means price moved from 106.90 down to 106.80, and then it had to move another 10 pips down to complete this brick. So a lot of people think, well, this only moved down 10 pips. No, it didn't. It moved down 20 pips. So if something moves down 20 pips like this, that's and then it forms, if it moves down 10, and then it moves down another 10 to form this red brick, that's a very good sign that you will have a continuation of that move, okay? And when you see some software and some charts will allow you to put wicks on your Renko bricks. There are some people who like this and some people who don't. Personally, I do like them, because what this means is that during the formation of this brick, price went this high, but it didn't last long enough for the brick to form. Is I think the best way to describe it. So when you see a wick on a Renko brick, that is a powerful signal generally. All right. Also, it makes it easier to trade and identify support and resistance areas, because they're pretty easy to find. Not there. So, this looks like a pretty good zone as a support and resistance band. So does, around here. Probably looking at around here. You can find a lot of areas to find support and resistance. It's easy to spot. You don't need to do a lot of work to find it. And then it's ultimately pretty simple to trade this, because right now, when I'm looking at this structure here on the dollar yen, I would have gone long. After this brick formed, I would have gone long. Now, you'll notice that what happens here is you'll see it kind of turns magenta, or if it turns blue. This is just telling us that right now the current price is printing lower than our last Renko brick. That doesn't mean anything, because it just means that that's where price is sitting right now. Because we could see this disappear pretty shortly. Price could travel all the way back up to here and then trade up. And the probabilities are that price is going to continue to go higher, and that this is just normal price activity happening within the Renko brick, because this is a very bullish Renko brick followed by another brick. And for right now, there is I guess we do have a little resistance up here, but really we have a good bias for higher prices looking at this. And so Renko is a very, I think for a lot of people, it helps out with the stress level of not having to worry about looking at candlesticks. Because if we look at the time here, so this Renko brick down here, if you look at the time below, 1 o'clock in the afternoon on the 17th, or sorry, 1 in the morning on the 17th, and then this Renko brick didn't form until 8 o'clock that night. So this red Renko brick only formed at 1 in the morning yesterday morning, and I'm talking about Central Time. So this would be in CEST. That'd be 8 o'clock in the morning your time, and then it didn't form again. Another brick, the one next to it, it took another 19 hours to complete this one. And if you think about it, okay, so this entire price action between just these two Renko bricks looks the same as Where are we at? Let's go to a 1 hour chart. 1 in the morning on the 17th is what we're looking for. All of this price action activity from 1 in the morning. Wait, that's not right. That was right. Never mind. All of this price action within this highlighted box is the same as what happened in these two Renko bricks. And so for a lot of traders, this kind of a setup helps you avoid the noise and the anxiety of looking at a candlestick. Because I think for a lot of new traders, you get excited and then you look at these candlesticks and they're forming, they're moving up and down, and you know, you get anxious and worried about what is price doing? Is it going to go higher? Oh my gosh, this candlestick is not, this is a bullish engulfing candlestick, but price is reversing and going down. It's not supposed to happen. This is so much of a headache. Whereas this is very simple. This is less noise. This is very easy to look at and analyze. I trade futures markets with Renko. I trade the NQ with Renko because it's a whole lot less noisy. And you know, you can still use volume price analysis and use it effectively. The regular volume is kind of pointless for this type of analysis, but you can still use volume price analysis. You can use pivots. Use pivots here. I should say monthly probably. Actually, it doesn't want to paint those very well, does it? That's all right. But yeah, that's just one type of way to look at markets. There's all sorts of different other charting methods. Now on TradingView, they have just like moving averages. I'm going to tell you not to use Heikin Ashis. Heikin Ashi has been the bane of many a new trader, thinking that they've done back tests using Heikin Ashi and they've found the Holy Grail. Heikin Ashi is not to be used for finding entries and exits. Heikin Ashi is solely for the purpose of identifying and following a trend. All right? Because Heikin Ashi candlesticks, the way they are calculated, they always open at the exact mid of the previous candlestick. Okay, I mean, we can see that right in here. There's the Heikin Ashi candlestick. Where does it open? Right in the middle of the last one. So the price that you are looking at on a Heikin Ashi is not the actual price that is being printed. You need to be very, very careful using Heikin Ashi. It is not safe. I think they should just get rid of it for new traders. Oh gosh, we could do point and figure. We could spend a whole session on that. Actually, multiple sessions on point and figure. Kagi lines. These are actually considered Gann swing charts. Gann swing charts. This is what Gann used a lot. He used these to trade, and it's a fairly simple way to look at this. I gotta answer this person back here. Okay. He said, okay, do this. So if you look, this is like the yin and the yang shoulders, waists. If you look at this here, we have a bullish buying signal, and it won't change red until we cross below this shoulder here. So Gann swing charts let us know when to take a long position or a short position after a trend. So if we look over here, we see that we had a waist to shoulder form here, and then once price crossed above that, then we turned green, and that was our entry signal. And these swing charts are extremely effective. They are extremely effective when utilized with other forms of Gann's analysis. So if I were to put, gosh, I don't know how that's going to work actually. I don't know if it'll scale it in there or not. It's not really, no, it doesn't work very well like that. So we'd actually have to draw our own, but we could do this. I got it. Make it easier to square our chart first. Let's square it in tenths, 10 pips. Actually, let's do it 5. No, 25. That's not right either. I want it a little larger. That works. Okay. So looking at our Gann swing chart from this style and utilizing his square, we can identify really easily where entries and exits are, and what is safe based on our angles. So if price were to return back down to this 45-degree angle and we had a shoulder crossover where it turned green, then we would have a good buying entry. But notice how when we crossed below this angle and we started to paint red crossovers, that was a good indication to go short at that level. So Gann swing charts, Kage lines. This is a very unknown, relatively not practiced form of trading. I have used it before. I think I would have to use it like for about a year to really get the kind of the mood and method out of it. So yeah, those are just some of the methodologies. I really like to spend some more time going over all these later on with folks. Well, anyways, I hope you found this information useful. And about Kage, no questions. Okay. Yeah. Hope you found the information useful, and I will see you guys tomorrow.